don't know if it's not clear to Wall Street. I just think that your average short seller on Wall Street these days is very timid and nervous. After GameStop, people would rather, I'll wait till it's closer, that type of thing. You know Shkreli don't play that way. But a lot of these guys are scared. They're scared. I can't blame them. That's how they was raised. Yeah, I mean, Growth Limited's at a really interesting point. You know, when I tell people that the S&P does not structurally go up, that the S&P does not structurally go up 7% a year, people are shocked. I'm sitting there, where did you learn logic and reasoning? What part of the world was there a contract that said the market must go up 7% a year? And then I hear, well, Martin, it has gone up 7% a year for a long time. And I said, okay, one time in New York, it rained 3 days in a row. And was I supposed to expect it to rain every day for the rest of eternity? Well, on the third day, I said, it's been raining a long time. It's going to keep happening. Past does not reflect the future. Post hoc ergo propter hoc. It's a simple thing. You look at what Elon calls first principles, what I call governing dynamics. Stocks are the output of a function. The input is the country, its policies, tax rate, productivity, GDP per capita growth, population growth. I say capita growth, but population growth, government spending, lending. All these things contribute to what real returns are. Real U.S. stock returns are not 7%. They're much lower. People don't include inflation, hence the real part. They don't include taxes. And most importantly, what was just said, which is why I'm responding to this, is limits. What's a limit? Well, when a country grows very large, it's harder to get it to grow. The same thing with a company. Only Microsoft seems to be defying this. When your company gets a lot of revenue, a lot of business divisions, a lot of bureaucracy, it's a little hard to grow fast as it was when you were small. Same thing with a hedge fund or a trading account. And so, you got this $30 trillion economy. It's a little harder to move the needle. You're sort of at this population growth. You're not going to get a population boom. In fact, if anything, population shrinking. That's kind of the issue. SPY down 1.3%. Some firmness here. Again, the sample size is big, but it's not really a sample size thing. There are bigger sample sizes. For example, the Roman Empire, the Netherlands, the Dutch Empire, the British Empire. You have a size effect. As a small country, it's easy to grow, easy to manage. As our country gets bigger and bigger and more sprawling, there's generally more fraud, theft, grift, bribery. Your systems become unwieldy, very hard to manage. People put their priorities above the countries. It's hard to root these things out, and all empires fail. Japan is a good example. China may be a good example right now. China in the past was a good example. Dalio writes a lot about this. Look, I'm not saying I'm bearish on the US, but you have to open your eyes and see that we have a big deficit problem. We have politicians that just want to give money out and cause inflation and cause more deficits. And if we stop it, we're going to have lower growth. A big part of that growth that you're talking about has come from deficit spending. If you got an economics degree like I unfortunately did, you can think about what's the equation that creates stock price changes. So stock delta, what's it coming from? Okay. Well, we know that generally stock prices follow their earnings. Okay. So we can kind of work backwards. So maybe the answer here is, earnings, long-term earnings. So what's that a function of? It's sort of a function of two things, kind of revenue and costs. So we'll take these independently, okay? So revenue, well, this to me seems like GDP. I mean, all the revenue combined, I'm not talking about Microsoft or somebody that's growing faster or really well adept, but if you think about all of the revenue, how fast is all of the revenue growing? Basically a GDP. What is nominal GDP is irrelevant, right? Where all we care about is real GDP. So real GDP over the long run seems to be around what, 2%? And real GDP is mostly a function of what? Productivity, right? So you can basically gauge success in economic activity with productivity. And productivity may be going up because of AI, for example. XKO knows CGI. The costs seem to have the same dynamic, right? They're, maybe a function of inflation too. But in general, I mean, margin is the question here. So let's say you have a 2% increase in revenue. It's a 102. And I don't know, your costs are 80. So they go to 80. Let's see here. Let's do 80 times 1.02. We'll get this exactly right. 6. So let's say you had 20 million in net income or whatever arbitrary number we're talking about here. You would have, let's see, 0.4, 20.4. In 20.4, this is a clean 2% increase. So if your costs go up 2% and your earnings go 2%, your revenue goes up 2%, your costs go up 2%, your earnings go up 2%. So you hope to get some leverage on your costs. And maybe that's where your productivity comes in. Or maybe instead of 81.6, it's, I don't know, just 81 or something like that. In which case, if it were just 81, your earnings would go up 5%. Now, earnings going up 5% could mean that stock prices go up 5% a year. But it's hard to see real stock prices go up any more than, something in this like 2 to 5% range. And then if productivity goes up, but there's all kinds of other things like graft that are hard to measure that cut into the ability for earnings to grow, things like taxes, etc. And if revenue has grown a lot because of debt, government spending, and that has to come back, maybe revenue will go down again. So it's really hard to tell if equities will really go up that much. I'd be careful assuming that. SPY down 1.2% here. I don't regret my degree. I'm just joking, like kind of an economist joke. How do you get your mind in the zone? I think you basically, one, you have to really want it, right? And I think people think they want it, but you have to really want it. And you also have to have the presence of mind where you're not just moving your legs on the bicycle, but you're really driving with purpose and with direction. Because it's easy to move your legs and pump the wheels of the bicycle, but it takes a lot more than that. When I was 17, if there was one stock I really cared about, now you could do this now with just charts, but let's say you're super focused on one stock, and I know some of you guys are super focused on HIMS. Let me pull up HIMS. And this is a little bit overkill, but some of you guys like to go overkill. I used to track, I do something like earnings estimates here, and I would just put the date, and I would put the different quarters and years. So I don't know, I guess I would do right now, Q2, Q3, Q4, 2025, 2026. Now we're about to get more years of earnings for Goodell so that you get even 28, 29, 30, stuff like that, which is sometimes important for stocks. But I would just jot down every day, every morning, I'd wake up and fill out this funny sheet. I stopped doing it after a while, but it's probably decent practice where you can fill out for revenue and for earnings. I think revenue is almost more important. Revenue, 565, 590, 636, 23, 28. So now almost like, and eventually you kind of memorize it by heart. This is the revenue expectations for HIMS. You should almost have it burned into your head. And then if you do this every day, you'll slowly see the number go up or down. And little changes like that can be major hints. That, maybe something's happening. Watch that like a hawk. If there's one stock you care about, and which again, I really don't think you should just have one stock that you care about. Watch that like a hawk, and sometimes you can spy something early on, because the Wall Street guys they'll always put on a nice face because they're trying to be nice to the companies. But if they lower their estimates, it could be something spooky going on. So anyway, there's the earnings estimates for HIMS, and it doesn't cost you much just to do this every day. And you just watch a trend. Now there's a lot of software that lets you just graph that. and we'll be able to let you graph that shortly. But I like to do it every day just so I can really focus on that. Yeah, 𝗤𝗏𝗄, basically, yes. Now, again, typically you need to be a customer of the specific firm to look at their earnings estimate, but we're working on it. So again, I don't take Wall Street that seriously as an aggregate. Each individual analyst is different, and somewhere in aggregate, it's important to watch the consensus. But if you're really focused on a stock, you want to know everything about it. It sort of behooves you to do this, and especially as you make your own model, and you say, well, I think HIMSS can do $4 billion in revenue in 2026. All these guys are at $3 billion because they're, the company wants them to be conservative so that they can beat the numbers. So if an analyst said to the CFO of HIMSS, hey, I'm thinking about putting out $3.5 billion of revenue as my estimate for 2026, the CFO and CEO would say, what are you doing? You're going to make us, if you make that the baseline expectation, that's going to hurt us a lot because I don't know if we can meet that. I mean, I think that these estimates, consensus is an average, yes. These estimates aren't to be taken too seriously, but if you do think HIMSS will have a $4 billion revenue number in 2026, you might want to have a conversation with one of the analysts to see if they think that's possible. Again, you may know better than they do. S&P down 64 basis points, just chilling basically. Capper at 10. Yeah, I think I would sell that vol. Sell the HIMSS straddle. Yeah, Jesus asked the question about doing 100 hours of research before start investing into a company. I still think that's very wise. People tend to not have the patience of doing it, but again, I want you to picture young Shkreli, 18 years old, working for a fund, and just sitting there with nothing to do all day. I do the little work that I have to do as an intern, answering the phone and letting Kramer yell at me and bully me. But when that's done, I'm just sitting there reading research reports. 100 hours goes by like that. To you guys, 100 hours sounds impossible. Where are you going to find 100 hours? But if it's your job to study stocks, you want to know these companies inside and out before you start trading. So that's why I really recommend, being a professional. People use CROs for trials. They used to do trials in-house, and now everyone uses contract research. So you just take the difficult part of the work and you send it out. And I think that I'll tell you this, every single biotech in the world and any pharma below a certain size will not do toxicology in-house. So now there's a lot of different kinds of tests. It's not just tox, but yeah, tox is something where you can actually, if you want a little bit of a hint here, the FDA does these reviews of drugs before they approve them. And oftentimes you can see where the tox study was done. It's kind of, I would say leaked, but it's kind of in the filings. And it's a really interesting thing sometimes to see who's doing it internally or externally. Everyone's external. I've seen so many drugs, they're always doing these tox studies, at some other company. All right, so free cash flow, net debt. Oh, wow. Holy moly. Net debt, 137 billion euros. Market cap's 153 billion euros. So I just want to make sure you guys understand this. I'll give you a quick lesson. I know you guys all know this. It's imperative. And, this is a euro stock. So everything I'm doing here is in this funny looking currencies. Is it like that? Do I get it like that? Okay. The share, sometimes they say in Europe, the share is trading for $31. We would say the shares are trading for $31. In the US is Deutsche Telekom. And there are 4.9 billion of these. So you have a very small piece of this pie. When you're a kid, you get a pie and you learn a little bit about fractions when you look at the pizza pie. You got 8 slices, you got 1/8 of the pie. Well, this is a pizza. Get a little house in here, little table. This is a pizza pie with 4.9 billion slices. So quite a lot of slices here. Really thin slice. That's your slice. It costs 31 euros to buy a slice. So if you think about it, it sort of makes sense that if you multiply these, you get the value of the whole company the whole is equal to the sum of its parts. I think that was either Aristotle or Euclid or both. So if you add all the parts, maybe you get the market cap, which is, in this case, again, we draw the euro thing, 153 billion euros. Okay, cool. But when I buy one of these slices, or let's say I buy 10%, what would it cost? It would cost you $15 billion to buy 10%. 10% is a big stake. What if Buffett said, I want to buy 10% of Deutsche Telekom? He could do it. He has the cash. But what am I getting? What is this piece of this slice of a pie? What am I actually getting? In this case, Buffett would own, I don't know, let's put him in green here, but he would own, 10%-ish. Let's say this is 10%. That'd be Buffett. So you'd say, well, what does 10% get me? Well, you buy 10% of the shares outstanding. That means you own 10% of the assets of the company, but you also have the claims of the company. So one way to look at this is on a net cash basis or an enterprise value, which we often say is EV. This is really important because if you just look at market cap, that's up here, it'd be really misleading. These guys say they have 137 billion euros of debt, okay? And 153 billion euro market cap, which is what we calculated. So what does that mean? Well, it means that this company owes creditors, debt bondholders, $140 billion. So the earnings that the company makes, which we just looked at here, free cash flow, 24 billion. 24 billion they're going to make, and it's kind of like clockwork. The next year they're going to make 24 billion as well. Maybe it'll be a little bit more, maybe it'll be a little bit less, but year after year they're going to make 24 billion. The bondholders have the senior claim to this, right? The equity holder, the pie slice holder, is not senior. He's sort of junior to the senior debt. Debt gets paid first. So they get the money off the top. And so why would they issue so much debt? Maybe to buy back their stock or for whatever reason. But the year after, if they don't do anything else, this debt will get paid down and it'll be what, 113? And it'll sort of become like 90. Is it going to be 90 or is it going to be even 80, 89, I guess? Not even, right? Why can't I do this math? 24. That should be 89, right? Am I crazy? Etc. And eventually, I'll put these in parentheses for negative, but eventually it'll turn into positive. It'll be $24 billion and then 48, and they'll be in the green. But right now they're in this debt position. So what we do is we subtract the cash, market cap minus cash plus debt equals enterprise value. And why are we doing this? Well, we want to understand what the value of the enterprise is, because if all this debt were paid off, theoretically the market cap would rise. Does that make sense? To 290. That's the enterprise value. If it wasn't for this debt, it would be trading at what, 10 times, 11 times this cash flow, 12 times, I guess. But the debt's in the way, so they have to pay the debt down. And the opposite would have happened with cash, where you'd have to subtract the cash, because the enterprise is not worth what the cash is worth. It's worth what's left over. So by adding this debt back, you get to figure out what the actual enterprise is, because as they pay that debt down, the market should be willing to pay the same amount for that cash flow stream. Here's the stream. Merrily, 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 24 billion a year. But instead of some of that going to the debt holder, less and less will go to the debt holder. So imagine they had zero in debt. Well, the market was willing to pay 290 before, so they'll pay 290 again, but it'll all go to the equity holders. So the share price will rise maybe to 62 or something, and the new market cap will be 300 billion, and your stock price will grow. So sometimes just paying off the debt is a very bullish thing for stock. So in any event, that's kind of what enterprise value is. If you don't understand that, I made other videos about it that are even more clear. Market is at down 150. It's going to be an interesting day psychologically. Earnings don't look great. Bad economic data. Nothing to really cheer about on equities. Risks seem clearly to the downside. Market's also resilient. Yeah, so this is a relatively large amount of debt for Deutsche Telekom. And that's not uncommon at all, by the way, in telecom. AT&T and Verizon are also massively levered. So technically, if you rank the world's companies by enterprise value, right, Deutsche Telekom would actually go from number 61 to number 28. It would be the 28th biggest company in the world. I don't know that its capital intensive is irrelevant to the enterprise value. You can be capital intensive and have a boatload of cash. I think in their case, many of the telecom companies, their earnings are so predictable and so reliable that they can borrow huge amounts of money to buy back stock or build out new networks. And that is capital intensive, of course. But I think it's just popular because you have, all this cash flow you can count on. And why not take advantage of it? Your business isn't going to change. Some of these companies, as you may know, AT&T, they've been around here 100 years. I mean, Verizon is just AT&T split, right? Verizon is a baby bell. All the baby bells, these guys have been around 150 years. They ain't going anywhere. So, eventually communications will be free when the Shkreli microwave transmitter comes. I mean, never mind. But regardless, hopefully we'll have more ease of communication. We don't have to pay these toll takers, but they do provide us with the ability to communicate. So there's a trade-off there. Yeah, Ken's saying it really smart. Ken knows what he's talking about there. Tesla always thought he could create all kinds of crazy technologies, but he did invent, right? What did he invent? Alternating current? As crazy as he was, he came through sometimes. Shkreli quantum communication network. Well, that sounds very expensive. So that's going to raise the costs of communicating. I guess I don't look at the world exactly the way like that. I mean, so the way I look at it is, every drug asset has a value of some kind, and I'm mostly looking for differences between the market price and that true price, if you will, that I calculate. I use my experience in looking at drug companies and running drug companies to inform some of what I do. There's sort of two separate parts to that, which are the development of the asset and then the commercial launch of the asset. Without one, you don't get the other, as you know, but the other gives you some boundaries for risk and opportunity. If the drug is commercial, it's usually relatively easy to price what it's worth. As you imply, most of the alpha comes kind of before drug launch, but that's not always true. Some drugs do better commercially than, they seem like they might. So that's kind of like some basics. They can raise the prices of European drugs. I think that some of them would lose revenue in a lot of ways. For pre-launch, I mean, I think that obviously, there's a lot of ways to cabin it. You never can really tell, what a drug is going to sell. Obviously, some proxies or analogs are always nice. I take like 3 or 4 different approaches. Proxies, I do kind of like a bottoms-up, patient-driven model. Then kind of my secret sauce, if there is any, is like a pharmacoeconomic impact model. So like I tend to believe that drugs will recoup the kind of pharmacoeconomic impact that they have. When you say common form, I'm not sure what you mean, brother. Are you saying like something easier to use, maybe? Oh, okay. Yeah. Trading terminal. Yeah, we might do something. Who knows? Yeah, this is a research terminal, obviously. Yeah, I mean, I guess the way I look at it is the cost to the healthcare system that is defrayed by the drug. That's kind of the way I look at what the pharmaceutical company's bounty is, basically.